Welcome to Financial Launchpad, a podcast designed to teach you about personal finance by starting with the basics and progressing to more complicated topics. We'll tackle a new topic every week and provide additional resources to learn even more and action items to launch your personal finance journey. I'm your host, Emily, and thank you for joining me as I discuss my investing origin story as an introduction to financial advisors. We've been talking a lot about investing and, rates and all of that. And it's finally time to get into financial advisors and telling you exactly how to do this. And I wanted to just tell you about the pros and cons of financial advisors, how to look for one and what they can do for you. But I kept coming back to our story. I need to explain our investing origin story in order to convey to you why I care so much and why my feelings about financial advisors are currently a little mixed. Thankfully, I'm reminded of not letting the perfect be the enemy of good. Was what we were doing perfect? No. Was it terrible? Also no. But that stepping stone of, quote, okay, led me to what I see as a better, closer to perfect situation now. The reason I started this podcast is rooted in this story. As I described in the introductions, I went from not knowing much to deciding to leave our financial advisor and that I would manage our funds. This whole podcast revolves around how to do that. This story explains why we did. First off, I am grateful to both of our families for being pretty financially savvy and starting us off on the right track right out of college. Both Sam and I had Roth IRAs pretty much immediately, and we were putting some money into them. Did we know what funds we were invested in? Hell no. To this day, I still cannot tell you exactly what I was invested in initially. After we got married, we decided to have our funds under one advisor for easier guidance. As I left my dad's advisor, he told me to look into Vanguard. I had never heard of this company and didn't even bother to Google it. I asked our new advisor if Vanguard was an option. He said no, and I said okay, and we went along with what he put us in. I remember him explaining the funds to us and the different options of A shares and C shares, something about fees on the front end or the back end. This didn't mean a lot to me. I knew he had a 5% fee right off the top, though. I recall a conversation with my dad at some point with me lamenting that I didn't understand this stuff or what an appropriate fee was. He asked what ours was, and I said 5%, which he said was crazy high. I didn't know. I only know now that we were in a loaded fund where 5% was typical, but he was likely thinking about financial advisor fees, where 2% is on the high end. Regardless, I didn't know at the time. We met with our financial advisor over the phone once a year. We went over the questionnaire that determined our risk tolerance. Yes, a very similar questionnaire to what I discussed in episode 5. Our situation didn't really ever change, so there wasn't much to talk about. He showed us a graph about whether we were on the right track for retirement. I should note, though, that he only managed our Roth IRAs. I also had and have a 401k through work that, aside from the initial setup where my dad's financial advisor told me what to invest in and setting up the automatic deposit to hit my match, I didn't look at it. It took me years to figure out how to log into it. Anyway, our advisor took the balance of my 401k into account when determining if we were on the right track, but he didn't actually know what it was invested in. This is where I have to butt in with current day financially savvy me. I talk extensively about how important asset allocation is for your retirement plans. If you haven't listened to episode 5, go back and listen to it. It is vitally important. How can anyone assume a rate of return for our entire portfolio when you only know what half of it is invested in? That's essentially what he was doing when he was telling us if we were on the right track for retirement, and including both the Roth IRA amounts and the 401k amounts. It could have been invested in bonds for all he knew. Regardless, I hope you're seeing here that the right hand didn't know what the left hand was doing, even with a financial advisor. Back to our story. This went on for a few years. Humming along, checking in once a year. At one point, we did determine that a decent spot to park some money, based on our goals and risk tolerance, was the Roth IRA, because I found out that you could take out your contributions at any time, penalty-free. Great. Also, during this time, Obama started pushing for a fiduciary standard across all financial advisors. Our advisor approached us about changing our investments and going with a different product that would charge a flat financial fee of about 1.1%, plus the expense ratios of the funds. He brought up the proposed change in laws and explained that this service line was now available to our level of meager investments because of this fiduciary standard. Okay, we signed up. Now, I need to drop a bombshell on you. Financial advisors are not inherently obligated to act in your best interest. They are allowed to present you with a, quote, suitable option that lines their pockets, even if a better option is out there that wouldn't make them as much money. A fiduciary, on the other hand, is bound by law to act in your best interest, but far from every financial advisor is a fiduciary. If you want a financial advisor, I highly suggest that you find a fiduciary. This whole conversation, though, about the fiduciary laws floating around Washington, switching our plan, really started to make me wish I understood personal finance more. It just seems so daunting, though, until I found 2 cents, then YNAB, and then the YNAB fans group on Facebook. I read books, websites, started listening to podcasts, and well, here I am. I will say that deciding to leave our financial advisor depended heavily on discovering index funds and deciding that the fees with our advisor were higher than I wanted to pay, and I didn't see how it was worth the fees. Do you know who invented index funds? Jack Bogle. Do you know what company he founded? Vanguard. Vanguard, you say? That sounds familiar. Yes, it should. It's what my dad's financial advisor recommended to me years ago. The one I couldn't bother to Google. Do you see why I care so much that you educate yourself? I'm speaking from experience. If I had bothered to learn some of this on my own 5 years ago, we could have possibly been in an even better position than we are now. We could have saved money on fees and have more money in our accounts. And I'd like to remind you, our experience wasn't bad, just perhaps not as good as it could have been. But it's that regret that pushes me to educate you. Now, I want this story to sink in a little bit. I want you to watch the John Oliver episode on retirement. Yes, it is a bit outdated, but there's a lot of good information in there, and my intent on sharing it isn't political. Read up about the now dead Department of Labor fiduciary rule. Yes, that's right. Financial advisors are still not inherently obligated to act in your best interest. Fiduciaries are still out there, and you can bet that when I decide we need a financial advisor, there'll be a fiduciary. I am not against financial advisors. I'm just against you blindly choosing one and thinking that they always have your best interests in mind. There are good advisors out there, but there are also meh ones. Next episode, I'll talk to you about how to choose a financial advisor, when you might need them, and some of the benefits. But this doesn't change my desperate plea to you to educate yourself. I provided some of my favorite recommendations in the notes. I highly recommend starting with Ramit Sethi's I Will Teach You to Be Rich. It sounds gimmicky, but it's a highly actionable guide to a whole range of financial topics. He has some sass, but he certainly will not bore you or talk over your head. I read the book earlier this year and actually bought the second edition on Kindle because of what a great reference it is. Also, just start reading J.L. Collins' blog, linked below, or the book version, The Simple Path to Wealth. This is the site that I learned about index funds and grew the confidence to manage our finances. My opinion is that you're going to have to learn this stuff sooner or later. Right now, I'm talking to my 20-some-year-old friends here. If you don't learn this now, your future self, at age 40, 50, 60, whenever you decide to pick your head out of the sand, is going to be pissed at you. I've only heard people say, I wish I knew this sooner, and I hear it often. I think it often myself, and I learned before age 30. Remember the power of compounding interest from episode 6? It relies heavily on time. The best time to start was yesterday. The second best is today.